everyone, today we are going to talk about index funds, mutual funds, and ETFs, and which one is the best for becoming a millionaire. Before we get started, I would like to say one thing. This is not legal advice. You should always talk to your financial advisor before making any decisions. I am not a financial advisor, so definitely before you make any financial decisions, be sure to talk to your financial advisor. Okay, let's get started. Hey everyone, this is Lauren Mack with Hacking the Rat Race, and I would love for you to hit the like button and subscribe so you don't miss any more videos on money, saving, and investing. Today, we are going to look at index funds. What is an index fund? How does it work? And then we're going to look at the best way to purchase an index fund, which would be through a mutual fund or an ETF, which stands for Exchange Traded Fund. So the first thing I want to talk about is index funds. What is an index fund and why is it better than a stock? So if you think of an index fund like a pie, and a stock is a piece of that pie. And with index funds, you can get index funds for so many different sections of the market. You can get index funds for the entire stock market. For the S&P 500, you can have bond index funds, emerging market index funds, international index funds, real estate index funds, technology index funds. Literally for any section of the market you're looking for, there is probably an index fund. Why is an index fund better than getting individual stocks? And the reason is because it is passive investing. You don't have to go research all the companies, look at what's going on, what are their projections, what is their liquidity, how are they doing, looking at stock charts and literally analyzing all of these companies. You don't have to do that. And the great thing is by having an index fund, it diversifies your risk. Because let's just say you are amazing at picking stocks and you absolutely love this. There are several examples of companies where things just happened that could not have been predicted. Looking at past earnings, productions, liquidity, future earnings, production models, nothing. So I'll give you an example. Look at Boeing with the 737 MAX. If you were looking at Boeing stock as that plane was being rolled out, there would have been nothing that would have indicated that two of them were going to crash and that most of the fleet around the world was then going to be grounded. This has a huge impact on Boeing stock. Again, looking at all of that, researching all of these things, you would not have been able to predict that. And another example that goes even a little bit farther back is Enron. Enron was this massive company. Everybody was celebrating them. Buy, buy, buy. It's so great. Even before, maybe hours, if not days before, everyone was super excited about Enron. But guess what? They were cooking the books. How would you have known that? How could you have known that? By looking at stock charts, by looking at all the things you would normally research for a stock. And again, let's just say you are doing your research and you're looking online for, hidden hot stock tips. Again, some of these things are completely unforeseen. And look at Enron. Everyone said buy, buy, buy because no one knew, or if they did know, they were hiding the fact that they were completely cooking the books. These are more modern examples of why doing all the research and investing in one stock can be super risky. If we go back to the pie analogy, instead of having one piece of the pie, you literally have a small piece of the entire pie. Let's just say you have the S&P 500, the top largest 500 companies, and let's just say 2 or 3 of them have one of these major blips. You still have 497 other stocks that can counterbalance that issue versus having purchased that one stock. So this is a great option because you don't have to do as much research. Literally, you pick the fund that you want to invest in and you just start investing. Now that we've discussed what an index fund is, how it works, and the benefits of buying a share of an index fund versus a stock, let's get into which one is better, the mutual fund or the ETF, and what is the difference? So the first one we're going to look at is the mutual fund. So we're just going to compare the Vanguard S&P 500 mutual fund versus the S&P 500 ETF. So the first thing I want to look at is the mutual fund, and we're going to look at the pros and cons of the mutual fund, and then we're going to look at the pros and cons of the ETF. So now we're going to discuss a mutual fund. First of all, what is a mutual fund? The most simple definition of a mutual fund is just a diversified fund that is actively managed by a professional. So you can have index fund mutual funds, which is what we're going to discuss, but a lot of examples of 401ks where you have a mutual fund that maybe has stocks, bonds, all kinds of different holdings to kind of balance it out, and it is professionally managed by that group. So as the market changes, things happen, they rebalance the portfolio. So that is the benefit of having a mutual fund. Now we're going to look specifically at a mutual fund that is an index mutual fund, such as the Vanguard S&P 500 Index Fund Mutual Fund. So the first benefit of this is that you can put a set amount in every month. So let's just say you want to invest $100 each month. Every month you can put $100 into this mutual fund, no problem. The second pro is that it can be automatically drafted. So each month on whatever day you choose, that $100 can be taken out of your account and automatically invested into that mutual fund. And the last pro of having a mutual fund index fund is that it is actively managed. That means someone's actively managing it. They're rebalancing it when needed, so it is actively managed. And this is one of the big differences between the mutual fund and the ETF. Now let's look at some of the cons of using the index fund mutual fund. So the first con is going to be a higher expense ratio. And this is just how much it costs to run this fund year over year. You can see here the expense ratio for this Vanguard S&P 500 mutual fund. This is really important because the higher the expense ratio, this is being taken out of the money that you earn, so this could have an impact on the total amount of money that you make over time. The next con is going to be taxes. So I got this little excerpt from Fidelity because I am not a tax expert nor am I a financial advisor, as I discussed earlier, but Fidelity breaks it down pretty easily, the difference in how you are taxed with a mutual fund versus the ETF, and we'll get to the ETF part in a second, but let's read what it says about a mutual fund. So it says, a mutual fund manager must constantly rebalance the fund, selling securities to accommodate shareholder redemptions or to reallocate assets. The sale of securities within mutual fund portfolio creates capital gains for the shareholders, even for shareholders who may have unrealized loss on the overall mutual fund investment. So basically what this means is that year after year, you could be paying taxes on this mutual fund because of them rebalancing, selling shares, and all of the activity that they're doing within that mutual fund. So that could be more taxes over time. And the final con of a mutual fund is that they are bought and sold at the time that market closes each day. So it is not like a stock where you can, as it goes up and down, purchase these mutual funds, which actually for a passive investor who's just putting your money in, that isn't bad, and it actually keeps you from wanting to time the market. And time the market is when someone's trying to get in at the lowest point and get out at the highest point. And just like you can't predict all these unforeseen things that could happen in a company like I described before, it is equally as hard to foresee when the market's going to drop, when it's going to go up. So therefore, if you just invest every month, whatever that amount is, then you're more likely to catch those highs and lows. I actually have another video called Should I Invest Right Now? And this video discusses how much to invest, how often to invest, all these other questions that maybe aren't covered in this video. I will have the link to it in the comments below and at the end of the video. So if you want to go into more detail on those questions, definitely check out that video. Now that we've reviewed mutual funds, now we're going to go and look at ETFs. An ETF, which stands for Exchange Traded Funds, is another way that you can buy index funds. These just track whatever the index that it covers. Whether that be emerging markets, like I said before, S&P 500, that is what the ETF tracks. So it is not actively managed in the same manner that the mutual fund is. So let's look at the ETF pros. So the first pro that we're going to look at is it has a lower expense ratio. If you look here, the ETF index fund, it is 0.03. That is one of the definite pros of picking an ETF over a mutual fund, is the expense ratio is so low, and the reason for that is because it's not actively managed. The next pro is taxes. So we're going to look at what it says about the ETF taxes on Fidelity. It says, in contrast, an ETF manager accommodates investment inflows and outflows by creating or redeeming creation units, which are baskets of assets that approximate the entirety of the ETF investment exposure. As a result, the investor usually is not exposed to capital gains or any individual security in the underlying structure. So for an ETF, What normally happens is you don't have to pay those reoccurring taxes like you would in an actively managed mutual fund. You pay the taxes when you sell. So this means if you hold it for a long time, with a mutual fund, you may have to pay taxes during that time of holding. Whereas with an ETF, most likely you won't have to pay taxes until you sell. And again, talk to your tax advisor, your financial advisor to get the exact details for you and what you're looking at. The other pro is it can be bought and sold like a stock. So there's a thing called limit. So the way that limits work is you can set a limit. Let's just say the share is trading right now, today, for $250. But that goes up and down daily, even hourly, even by the minute. One thing people can do is you can set a limit. So what that would look like is you would say, I want 5 shares, for example, at $245. And this limit buy could be good for 1 day, 60 days. And what that does is if the market dips down to $245, it initiates that buy. So this way, if you're trying to time the market, which you can't really time the market, but if you're thinking, ooh, if it gets to this low, I would love to have a lot of shares, you're able to do that with an ETF. You're not able to do that with a mutual fund because, as we discussed before, those are bought and sold at the end of the market close. So whatever the price is then, that is what you're getting. Whereas with an ETF, let's just say maybe 1 hour or even 1 minute. It's $255, $250, $245, $257. But the thing is, if it closes that day at $258, then if you were using the mutual fund, then you would be buying at $258. Again, that's not a bad strategy. And if you watch my other video, it talks about dollar cost averaging, which is a great investment strategy. But if you would like to be able to take advantage of this, then being able to buy and sell the index fund like a stock is a huge benefit and pro of an ETF. Now let's talk about the cons. The first con is you don't have automatic drafts like you did with the mutual fund. You can't just set up $100 every month, comes in, and it just gets invested. You have to invest these manually. Unlike the mutual fund where you can literally have it drafted and invested and you don't even have to think about it. The next con is people are tempted to time the market. And the problem with this is if we look at the example that I just gave with the limit buys, well, let's say you set a limit at $245 on the example of the share that is currently selling at $250. Well, if it never hits $245, you're never going to have that sell, and you might be tempted to wait, which means that you're not going to invest. Timing the market often means people don't invest the money that they have. Therefore, they're not putting their money into the market to invest for the long run, and this can actually end up being a con. And the last con that you will see here has an asterisk is you have to buy full shares. So if you use a company like Schwab, for example, one con is you have to buy a full share. So if it costs, say, $250 and you're only investing $100, you would not be able to invest that money until you had $250. However, there is an asterisk there because if you have the Fidelity app, they do let you buy fractional shares of ETFs. This means that if it's $250, you still can purchase $100 and you can actually do limits on that as well, but you have to use the app. You can't use their desktop version. And for example, if you have someone like Charles Schwab, at the moment on April 13th, 2020, you cannot buy fractional shares on, say, Charles Schwab's website. You have to buy full shares. So for some people, this can definitely be a con because if the amount that you're trying to invest is less than 1 share, then unless you're using something like the Fidelity app, you are not able to invest that money. So now that we've looked at index funds, mutual funds, ETFs, what the differences are, what are the pros and cons of using them, the last question that we have is, which one is the best for becoming a millionaire? Number one, just getting in the market early as possible. That is the best way to become a millionaire the fastest. I would say though, and again, you need to talk to your financial advisor, my opinion is that for 97% of people using the mutual fund, where you can automatically invest every month without thinking about it, without looking at it, just put the money in, and that is as much money as you have to invest, that's gonna be the best and easiest way to becoming a millionaire. However, maybe if you are really into stocks, you love looking at the market, the idea of limit buys and things like that really excite you, then investing in ETFs might be the best option for you. Personally, I have both. I love both, but I also am really into investing. So the number one way to becoming a millionaire as fast as possible is going to be investing as much as you can in regular intervals in either the mutual fund or the ETF. If you're considering which index funds you should invest in or what mix, I would definitely recommend talking to your financial advisor. Generally speaking, the closer you get to retirement, the more secure and less aggressive you want your investments to be. I personally love the S&P 500, the whole stock market index, and international index funds. But again, depending on your retirement horizon, your age, your risk tolerance, those may not be good options for you, but I would overall definitely recommend index funds over trying to research companies and pick individual stocks. I want to hear from you in the comments below. Are you going to invest in a mutual fund or an ETF? Which one sounds best to you? And if you're already investing in one of these, which ETFs or mutual funds are you investing in? Thank you so much for watching this video. Please don't forget to hit the like button. It literally costs nothing and it does so much for this channel. And don't forget to subscribe so you don't miss any more videos on money, saving, and investing. Thanks again, and I look forward to seeing you in the next video.